Hi everybody, and welcome back to FANG Friday. This is Ross Healy, the Chairman of Strategic Analysis Corporation and the Senior Portfolio Manager at McNichol & Associates Asset Management. I pointed out last week that overall the FANGs were looking a bit wonky, and nothing has changed in this past week except that it almost appears that the FANGs are getting more in sync with each other. I'll show you what I mean today when I take a really close-in look at the recent valuation action of the FANG stocks plus Tesla, I almost regret to say, as you will see in a moment. However, before we take a close look at the FANGs, as always, I do like to say thanks to everyone who likes this videos and all our subscribers. Okay, let's start off with the FANG stocks, including Tesla, which are in what I like to call my phantom FANG portfolio. And of course, first and foremost, there is Amazon. And what you see here is that Amazon has pulled right back down dead to its HB2 price, that is 12 times book value, and that is a 10-year low for the stock. So it had better hold here. Otherwise, I would be very, very nervous about what might happen for not only Amazon, but also the NASDAQ 100. Apple has held in nicely, certainly above its HB5, which is 26 times book value, although, as I have warned you before, there could be quite a change in the balance sheet, which the new balance sheet, which will come in about 2 or 3 weeks' time. And what I've done is I'm showing you the longer view of Apple. And you can see that when Apple had been buying back shares, okay, that the balance sheet had, the trend had one value. But, and here's the last balance sheet date, since that time, the balance sheet, of course, as we show it, was rising very, very quickly, because when I look at the implied return on equity of the stock of the company, it's 90%. And when you've got a book value of $6.50 and your earnings are $5.86, then the balance sheet's going to go very rapidly unless the company buys back shares. So I will be watching to see what happens very, very closely here. By the way, the fair market value potential, which is what I would like to draw your attention to as well, is minus 52%. So if anything ever goes, I guess what you might call wrong with the stock, there is a lot of downside risk. I forgot to mention that when I was showing you the picture of Amazon, because the downside risk there is minus 70%. So these stocks are not without severe risk. Now, turning to Tesla for a moment, talk about almost manic depressive here. Here is just the last 3 months, and you can see the extreme volatility of the stock. The stock actually rose to its HB7 and then set back very quickly down to its HB6, which is 33 times its book value. Had a big rally, and then on the news that Elon Musk was selling a lot of his shares, and by the way, if I were Musk, I'd sell a lot of my shares as well. The stock actually gave us a confirmed sell signal, which you can see in here. That is to say, the stock went through support by 3% or more and held there for 5 days. However, once it was announced that the sale was over, the shares virtually leapt back up over the HB6 would have given us a buy signal, but we had to wait for the confirmation. Well, we just got the confirmation as the shares pulled back to its HB6. Well, it's got a hold in here. And as I say, given this this volatility of signals, this does not give me a lot of comfort. However, from an SVA point of view, we'll have to say it's in the Phantom FANG portfolio. Now, last week we had Nvidia in the portfolio as well. However, as I warned you last week, the stock had just cut through its HB5 price. Okay, that is 26 times its book value. And subsequently, in this past week, had actually given us a confirmed sell. That is to say, that 3% 5-day rule of thumb, not a hard and fast rule, but a rule of thumb, has now given us that signal. And at this juncture, I would expect lower prices ahead. Now, we have had 3 stocks that were absolutely in a confirmed downtrend, and the first one was Microsoft. After it hit its peak at its HB3, which is 16 times its book value, that was it. As I warned you at the time would be the case, and the stock has been heading lower and lower ever since. It's now actually fallen so far that it's only about 5 or 6% away from actually hitting the HB2 support level, which is 12 times book value. Lastly, I want to point out one thing about Microsoft, and that is to say that its fair market value potential is minus 47%. So even though we might be getting to a good trading condition with the stock in a long-term sense, the intrinsic value of Microsoft is definitely on the speculative side of things. Turning to Netflix, well, we see very clearly that, well, as I have been warning for some time, that Netflix is in a clear downtrend. It would now appear to be heading very much for its own HB2 level. Again, that's 12 times book value, where, as in Microsoft, I would expect we would get some kind of rebound as well. The thing that concerns me most about Netflix, however, is when I look at the fair market value potential of the company, it's minus 58%. So this stock is not without its substantial risks, and given the dynamics of the streaming business, I do have some longer-term concerns about this stock. Looking at Facebook, rather than having a short in look, I really showed you the stock for the past 4 years, because I want to remind you once again of the very, very clear peak that this stock has always made at its bubble price, which is 7.4 times book. Every single time that this stock has peaked there, the stock has set back at least to its mid-super growth price, which is 5.5 times book value. So I would simply be patient and wait for it. The one thing about Meta, however, that does concern me somewhat is what is the actual trend of the balance sheet. For the first time in the last quarter, the stock actually bought back, or the company actually bought back a big slug of stock, and it changed the trajectory of the balance sheet. Now, since that time, of course, we don't have a new balance sheet to tell us where the actual book value is, but if they've continued to buy back stock, then the target of this company may not actually be the $298 value for the mid-super growth price, but it may be something a little bit on the lower side. Fortunately, we should have a balance sheet in fairly shortly, and we'll see then. The last stock that I want to review is Alphabet, and as you know, if you've been tuning in to FANG Friday for some time, this, in a sense, has kind of been my favorite stock. And by the way, it also is the favorite stock of virtually anybody who is following the FANGs, and indeed is following the Nasdaq. I have heard over and over again people saying, well, you know, there's a lot of risks in the market, but, you know, if I had to hold one stock, it would be Alphabet. Well, let's go and take a look here at its fair market value potential, and it's only 29% lower than the current price. So of all the FANG stocks, except for Meta, which the downside risk is minus 23 to its fair market value, then it does represent the best value. However, from an SVA point of view, there is very clearly, I think, downside risk to its mid-super growth price, 5.5 times book value. So I think I would be prepared to stay out of the stock for the time being and watch it. You don't even have to watch it carefully because it's some distance away. Now, in review, as I said last week, and I'll say it again, after that review of the FANGs, I don't know what your reaction is, but mine is decidedly to be on the cautious side of these stocks, and indeed the overall NASDAQ 100 as well. As of last week, there were 4 of the 7 FANG stocks, plus Tesla, in what I called my Phantom FANG portfolio: Amazon, Apple, Tesla, and Nvidia. Nvidia has failed to hold its HB5, or 26 times book, and has given us a confirmed sell, leaving only 3 stocks in the buy-hold group. I do have a problem with Tesla, as it has been so volatile recently, and actually offered a confirmed sell and then a confirmed buy signal on Elon Musk's sale of shares. The stock looks to be almost manic depressive, and it gives me little comfort to even suggest that you should hold the shares, especially given that the fair market value of Tesla is 85% lower than today's price. Looking at Microsoft, Meta, and Alphabet, all 3 are in clear downtrends that will either take a lot of strong upside market action to reverse, or will permit them to fall to levels which will offer strong support and therefore good trading opportunities. My best advice here is to wait for them. I hope, by the way, that if you've learned anything from SVA in the past 2.5 years, is that patience is often rewarded, but you need to be ready to take advantage of opportunities when they occur, as they tend not to last very long, as we recently saw with Nvidia. By the way, in today's, that is Friday's weak market, the 3 FANGs, which are the most advanced in their own setbacks, are also the 3 FANGs which are actually up on the day, albeit modestly. So I would keep a close eye on them as they reach potentially their nearest structural support. There may be terrific trading opportunities ahead. Alphabet and Nvidia are too far away from any support to do anything but watch from the sidelines. All in all, this is no time to be a hero, as it is clear that the cavalry in the form of the Fed is not going to ride to our defense. As a final consideration and reminder, I would hate to see Amazon break support because of the potential implication for the NASDAQ 100 stocks in general. It is sort of my personal canary in the coal mine. As I was careful to point out this week in my review of the stocks themselves, the intrinsic value of the FANGs and Tesla are miles below their current prices. I watched the same story unfold in the period 2000 to 2002, and it was not pretty. Although there were a lot of good, even great trading opportunities during that period. Since the peaking of the NASDAQ 100 in October, we have already seen a goodly number of NASDAQ stocks disappoint and plunge, as their prices also vastly exceeded their fair market values, leaving no support under those shares at all. As a final thought, if you'd like to see where your own stocks are sitting in order to assess the riskiness of your portfolio, email us at info@strategicanalysis.ca, and let's see if SVA can keep you out of trouble and make you money as well. For now, this has been Ross Healy, the chairman of Strategic Analysis Corporation and a senior portfolio manager at McNichol & Associates Asset Management, reminding you that nothing, including investing, is difficult if you have the right tools. We'll see you